Welcome everyone to another episode of Wolfe Street. For those of you that don't know, my name is Wolfe, and for those of you that do, thanks for checking me out again. This will be a video version of a weekly preview for the week starting July 20th, 2020. If you're listening to the audio version, there it is a YouTube video version on my YouTube channel. So please feel free to check that out, as I find it's a little bit more helpful to see things from a visual perspective. As always, you can reach out to me directly on social media, on all social media platforms at EveryTimeICash, or you can reach out to me directly on my website, everytimeicash.com/contact. You could also check out my website in general, everytimeicash.com, and check out some of the additional free resources available on that site. If you have any questions, comments, concerns, please feel free to reach out directly on my website, everytimeicash.com/contact, or using at everytimeicash on social media platforms, or simply by hitting reply or commenting in the comments section below. Today's going to be a video and audio preview for the week starting July 20th. I believe it is the week ending July 25th. Let me double check that. Yes, it's the week ending July 24th. So if you want to get any sort of insight about what I think may or may not happen in the coming weeks and in the coming days, and some of the things that I am targeting for this following week, this video is for you. Some of the topics that I'm going to cover are going to be the abundance of buy the dip, where we stand on a historical front, and where we stand relative to where we were 3 months ago. Some of the things that I'm looking for in the next couple of weeks and in the next couple of months, along with some of the risk factors involved for the overall marketplace. And last but not least, the earnings front. We have a heavy earnings period that starts this week, goes into the next couple of weeks, and I'm going to kind of go over some of the things that I'm looking for from that perspective, along with how positioning can matter moving forward with those things. So without further ado, and without my rambling any further, on your screen, you're going to see the ES, which is the S&P 500 futures contracts. As you can see on your screen, we have a pretty critical juncture for the S&P in general. We've banged up against this breakdown level from late February. February 24th was the breakdown, and then fall through on the 25th of February. So this is essentially the COVID-19 breakdown point for the overall market, and we are just now banging up against that resistance level. It's important to note on that front that we have been the beneficiaries of a constant buyback scenario for the overall marketplace. So investors, traders, the Fed, all participants in general have been conditioned to buy the dip. This has come on the heels of unbelievable liquidity and a liquidity stream that's been given to the marketplace and to investors in general by the Fed. And with that liquidity, we've been targeting upside. I mean, when I say we, I mean investors in general, or traders in general, have been targeting upside as the Fed basically set a backstop to the crisis that we had on a financial and health front by injecting liquidity into the marketplace. On your screen now, you'll see the Nasdaq 100 E-mini futures contract. This chart is representative of the bulk of what we've seen with the overall marketplace. So as I said, on the front end, the Fed stepped in, built a money bridge to try to get us through the COVID-19 problem. essentially they said, let's just throw as much money as we can at the situation to avoid a liquidity squeeze, which would then avoid a potential destruction of risk on assets. And in doing so, investors in general and traders in general, as soon as the Fed set the backstop, started to target different asset groups, primarily risk on asset groups, to invest in and to trade. And we've been the beneficiary of a very strong tech sector and a very strong, essentially, handful of names. So on your screen, you see the Nasdaq E-mini futures contract chart. You'll see that when we bottomed in late March, let me pull an arrow out for you so you can see it a little more clearly. When we bottomed in March, here is the arrow that signifies it. We created a little bit of a higher low that started with the beginning of April, and that was essentially when the Fed stepped in and said that they're willing to do whatever they can and whatever it takes to get us through the other side. You started to see investors flock into what they deemed quality growth names, and that essentially was about 15 stocks. So you've got things like Apple, Microsoft, Google, Amazon, etc., that were really beneficiaries of this. And then you also had, on the other side of the barbell, you had other tech names like Zoom, and you had DocuSign and things like that really performed as a beneficiary of just the work-at-home environment. But primarily, the whole point I'm trying to get at is we created a set of a set of higher lows, and then we've been up and away ever since. Ironically, or not ironically, depending on how you look at it, and for me, it's not ironically because I'm a technical trader for the most part, you've kind of seen a respect of this uptrend, which I'm going to highlight here in pink. You've seen a respect of this uptrend in the tech sector, where we've tested and held along the way. That trend has, not ironically, in my opinion, coincided with the 20-day in general, where I identify and a lot of traders identify the 20-day as a momentum indicator. So the tech sector started to break out above that 20-day, and ever since it's kind of been riding that 20-day as support every time it's checked back into it. Or you can just use a standard trend, which is what I have here in pink. We've ridden along this uptrend, and we're kind of at an inflection point for the tech sector, which in turn kind of gives us an inflection point for the overall market. One thing to note, and this is a courtesy of Jim Bianco on Twitter. I really like some of the things that he puts out there, so all credit goes to him on this one. This is not my work, but this is a daily average revenue trading for the Charles Schwab company. So I'm gonna move out here for a second and show you a different one. Let's start here. So this is Charles Schwab put out total active accounts. They publish this information, again, courtesy of Jim Bianco. And it, as you can see, in 2020 in general, we've seen an explosion in stock accounts. And this is especially highlighted on the orange part of this chart below. So this chart down here in orange just shows you how many new accounts have exploded and how many new accounts were created in 2020 relative to any other year. And so you're looking at a 3.5-fold on accounts versus last year. So last year we had 0.4 million accounts opened. If I'm not reading this correctly, excuse me, I'm doing this in real time. So in 2019 you had So in 2019, you had 0.4 being the highest quarterly account openings in general. And in 2020, we just had a 1.4 million roughly account opening for Charles Schwab. This is a situation where it just kind of highlights the, I don't know if you want to call it euphoria, or if you want to call it hubris, or if you want to call it the DDTG barstool crowd getting involved, or if you want to call it the COVID work from home crowd getting involved, if you want to call it free money handed out to people getting involved. Essentially, what this is just saying to you is that there's a lot of new money or a lot of new participants in the market in general. So again, the orange part of this chart highlights just how explosive participation has been as of late. So you've got an insane amount of people just now entering the market. And then if I show you the next one, this is daily average revenue from trading. They call it DARTs. And you'll see that there's just been an astounding amount of people participating, and an astounding amount of number of traders per day on a quarterly average the last two periods. So you've had pretty much average participation with a little bit of an uptick last year, and then just an explosion this year. And this is a confluence of events, right? So this is a lot of people being stuck at home with nothing to do. There's no sports on at all. There's no entertainment in general on at all. And there's a lot of people that just are looking for a way to make money that they may or may not have done in the past, given their experience and given the fact that they were making money from work and other facets of life. So you've had this really massive confluence of events. It's been backed by the Fed in general, and it's created this up and away, and this buy the dip attitude, in the stock market in general, primarily in tech, which has been viewed as quality. And I'm not here to argue about whether or not tech is quality or if it's hubris. For me, I find it that I prefer action to the upside as long as there's no catalyst for downside, because it's just a little bit of an easier trade. Now, once we get a little bit of a catalyst, like we get, let's say, the COVID thing that we had in late February, it's not a problem for me to short. Or if we just get to a point where the Fed backs off, it's not a problem for me to short. But essentially, going up into the right is a lot more of an easier trade when the Fed has your back, and when participation in general leans bullish, and when 70% of the time stocks go up in general. So that's just a little bit of a perspective and a little bit of backdrop. Again, now on your screen, you'll see this Nasdaq uptrend, and it's important to note this uptrend because we've had, like I said, an unprecedented amount of buy the dip. Buy the dip has been a way of life. It's been pounded on the table by new participants and by old participants alike. Trying to short the market in general has been a death sentence, especially with the amount of liquidity that's been involved. And the reason that this uptrend is important is because we are now going into 91 trading sessions since we've seen any sort of consistent drawdown period in tech. So this is courtesy of Carter Worth. He brought this to my attention. And I believe that between the last time that we saw this was in 2004, and it was pretty much a 6-month period between August and November. And in that period, the S&P tech sector saw 108 trading days before they saw consecutive 3 days of selling. And this is important for us today because along the way on this uptrend, we've seen multiple instances where we've seen a drawdown of 5% or more. So we've seen these drawdowns take place, but they've been pretty quick and they've been absorbed pretty quickly. Now, we haven't seen any persistent selling, since we saw, since we started this uptrend 91 sessions ago in the S&P tech sector. But we are seeing, this this uptrend potentially getting tested in that tech sector. And I understand that on your screen is not the S&P 500 tech sector. It's just a little bit easier to navigate back and forth by showing you an uptrend and giving you this data. So just bear with me. Trust me. If you want to look it up yourself, you're welcome to do so. We're on an uptrend on tech on the S&P as well. It's just a little bit easier for me to navigate this because I don't really know all the tickers on TradingView. I do know them in the platforms that I use, but TradingView in general, so there's a little bit of disparity there. Now, the reason that I bring up this item that Carter Worth brought to my attention about 108 days consecutively without having a 3-day consecutive drawdown is because once we got to that inflection point in 2004, we did see a sell-off of 15% in that tech sector after we got to that 108 session of no 3 days of consecutive selling. This is important again because we've got serious buy the dip complacency. We've got the Fed saying that they have your back. We've got earnings season, and we've got a lot of participation that we never had before, and a lot of quote unquote investors getting used to just buying the dip. In my personal life and in my trading group in general, there are a couple of characters that I've identified with nicknames. I've got a couple of friends that are new to trading in general and new to investing in general. And these guys are not the kind of guys that get in on things on the early front. They're guys that kind of tag in on the late front. To give you a little bit of background here, I've got a friend that wanted to borrow a pretty hefty line of credit from Navy Federal on pretty much no collateral so that he can invest it in the markets. And he essentially, had he gotten that money, would have invested right at the top. That's one guy. We call him Navy Fed Man. I have another guy who has worked pretty much his whole adult life in the pool cleaning business. Guy has no formal education, and he has no formal training in anything math-based, really, let alone the stock market. And he recently got involved and started participating, I want to say, in late April. And then I have a third individual who is a lawyer by trade, but seems to always catch the worst timing to get involved in anything. And the reason I bring these people up, and the reason I call them lawman, poolman, Navy Fed guy. So I will make references to these people just to give you a little context, and I make references to them because I use them as my Robinhood indicator or as my general Joe Schmo indicator. And typically when I start to see that those guys tilt to the upside is when I start to lay off on the upside, and vice versa. I've found them to be quite ironically or not ironically the tells in the marketplace. But I digress. So we've had 6 instances since the March lows where we've had drawdowns of 5% or more, none of which have lasted longer than 3 days. We haven't had 3 days of selling in more than 3 days of selling in 91 sessions. We're currently in an uptrend in tech, and that uptrend is coming to a head. It's highlighted on your screen by this arrow. More than that, we haven't really broken the 20-day on tech, and we haven't really tested the momentum, we haven't really tested the strong support on the upside or the strong support moving averages on the upside for tech and for the market in general. Outside of that, there's a few other items that I can go over. And the first and foremost being the the idea of what can possibly bring the market down. If the Fed has the back of the market, and if people are conditioned to buy the dip, and if we've got all this stuff that's taking place, what could possibly bring us down? Well, first and foremost, we have an earnings period that's taking place, and on your screen you'll see the Earnings Whispers calendar. This is provided by Earnings Whispers. Good follow on Twitter. Pretty sure they have a website as well. I'm not positive, but I use this calendar as a really awesome visual to give you an idea of some of the things that are coming up on an earnings standpoint. So you've got earnings in general. So during earnings, you'll have a blackout period. Blackout period is just generally companies postponing their buybacks to avoid being accused of insider trading or anything like that. So we're in the middle of a dead or quiet period, which is just companies are not buying back stock currently if they have to announce their earnings in the next couple of weeks. And in that instance, that is just like one fewer participant from buying the equities or the stocks in general. So if you've got one participant fewer, that is an absence of liquidity that has and does help stocks go up. So if it's all these stocks that are on my screen currently or on your screen currently, these companies are companies that if they have buybacks, they're going to be in a quiet period for them, for all intents and purposes, and that is one instance that could kind of dry up an uptick. That's one. So the second thing is if you just look at valuations. If you look at valuations, we're stretched on pretty much any front. So the reason for this is if I've got interest rates at zero and for all intents and purposes, the Fed's got my back, I got to put my money somewhere. I can put them in risk on assets, and I can just kind of validate whatever multiple I want to pay for these stocks. And just to throw out an example, Adobe is loved by everybody. It trades at 50 times free cash flow, and it trades at 19 times sales. Another one is Tesla. Tesla trades at, it doesn't matter what metric you use, trades at absurd bubble valuations, right? So if you just look at it from a pragmatic perspective, there's a quiet period for buybacks, and there's heavy valuations across the board. So that's two items that I can note. The third one will be that there are heavy weighings on the overall marketplace from a couple handfuls of stocks. So I mentioned on my last video and podcast that the top three companies account for about 17% of the overall S&P 500, and that comes in at around $4.6 trillion. This is the equivalent of about 300 or the bottom 300 S&P 500 companies. You can extrapolate that a little bit more, and that just comes out to the FANG stocks, just those four FANG stocks, and Microsoft come out to about 23% of the marketplace. And if you pull that out even further, the top 15 companies are the same weight as the bottom 420. So when you look at things from a pragmatic standpoint and you start to think about things that could set us up for failure, a lack of a buyback, and then a come to Jesus moment for these stocks in general could set you up. And when I say come to Jesus, I mean like when the numbers are actually shared. So let me pull this up again for you. So when these companies that are on your screen start to report earnings, and if their earnings are just actually shit, then people will be like, oh, wait a minute, we've been buying these stocks on the back of this optimism that, we're going to get through this COVID scenario and that earnings don't matter. But if there's something under the surface that they haven't planned for, this could set things up for failure. I'm putting up on your screen here a performance chart. This is just to give you an idea of performance year to date for some of the most popular stocks. This is everything from Tesla down to Honeywell. This is courtesy of TradingView. I saw this, I liked it, I wanted to use it, so shouts out to them. Thank you for this visual representation. And I solely bring this up just to kind of outline to you just how vastly how vastly exponential Tesla is relative to even Amazon, which is up 60% year to date and has been on an absolute tear in and of itself. So when you look at this, or when I look at this thing, I'm thinking to myself like, okay, so Tesla is at a point today where they are up so much that the bar has to be at a higher elevation point. And in order for them to potentially prosper from their earnings release, which is on Wednesday, they would need to just really elevate up and away and above that bar, right? So that is just an example. That's one way to look at it. And it's just one of the things that I kind of factor in when I look at things. Another thing that you should look out for is the potential drying up of funds that people have gotten on the back of this COVID-19 relief. So if we start to see a lack of additional funds or additional money or additional pay package to individuals who are struggling on the back of this COVID-19 situation, then whatever liquidity that we had been printing might not have been enough, and you can start to see that start to swell into the market in and of itself. Another instance to look at is if this COVID thing doesn't actually get better, or if there is actually a second wave, that money bridge that the Fed built might not be enough. Another thing to look at is the potential seriousness, I guess, or if the market is to start taking seriously the potential that Joe Biden being a president is a potentially real thing. So if that starts to happen, Joe Biden's got some very hawkish corporate tax policies or rates or whatever you want to call it, and that could spill into the marketplace in and of itself. Now, for me, I personally argue that the market is willing to price in anything if it knows what it is. So if there's a real potential that Joe Biden can become president, you might see that knee-jerk sell-off initially just to price in the fact that he's hawkish on corporate taxes. But if that is the scenario, or if that is something that actually starts to manifest, the potential that you have a higher corporate tax rate, I think it's like 28% higher or something, if that actually starts to become a reality, the market will eventually price that in. And then once you actually know what the information is, or once the market actually knows what the information is, it can start moving forward from that point. So these are things that I look for. These are things that I think about where we are and where we could potentially go and what could cause us to go lower. And then just on a final note, and this is a little bit it's a little bit related, but it's not too related. The Nasdaq 100 has, on a relative basis, just recently, as of last week, returned back to its 1999 peak. I don't know how to do this on TradingView. This is what I was getting at earlier when I said I'm not familiar with some of the different tickers or some of the names or some of the tools that are on here. But if you want to look that up, feel free to do so. The Nasdaq 100 just recently returned back to its relative high that it set in 1999. So we're basically at an absolute peak, and we're literally at the top once again. If we can't see any further upside, this sets up for a very dangerous pivot point for the overall market. And like I said, we have 91 sessions where we haven't had 3 consecutive down days, and we're just about at the inflection point or on the trend line. So do we stick the landing here and move higher because earnings are better than investors had feared, or do we open the door for something that we aren't expecting, or for something that may set more selling in motion. So these are some of the things that I look for, some of the things that I think about, and these are some of the things that I think are important to consider when you are trying to figure out whether or not the overall market can continue higher. Now, if you just look at the overall market, and consider it as a scale or as a seesaw or as whatever, like I said, we're at the inflection point where we started to sell off in late February. We've basically created this giant cup and handle. If we break out, we can set up for potential to retest the highs. But if we're unable to do so, then we just set a lower high and we're setting ourselves up for a further downside. Now, if you think of it in terms of a scale, or if you think of it in terms of a seesaw or something like that, given that there is such a heavy precedent on FANG or FANG Man or MAGA, whatever acronym you want to use, since there's such a heavy concentration in about 15 names in the overall market, if those names start to sell off, you want to see the other names start to participate on a greater scale. So if I just think of things pragmatically, if I've got Amazon, for example, and Amazon is now starting to reject its 5-day and is up 60% on the year and has already told investors that earnings are going to be an issue potentially moving forward because they're in their spend cycle. If that's the case on Amazon, then as soon as, for me as a trader, as soon as this 20 days is breached, I'm looking at the 50, 100, and 200 days as a potential retest to the downside, right? So if I'm looking at this 200 day, for example, which kind of comes close to this breakout point in Amazon, right? And by the time it got there, it'd probably come to this breakout point in Amazon. So if I'm thinking of things in that perspective, so if Amazon goes down, then how many companies need to go up in similar fashion to offset Amazon, right? So given that the market is weight oriented, then I would need the equivalent of whatever Amazon weighs in the marketplace times the percentage that Amazon goes down to offset whatever it is that Amazon goes down, right? So if you just think of Amazon, say Amazon goes down 3%, then I would need enough companies that weigh the same as Amazon to go up 3% to offset that 3% loss in Amazon, right? So if I'm thinking of things like that in a pragmatic perspective, then I would need either participation from some mid to large chip names, mid to large industrial names, banking names, whatever the case may be. I just need more participation in order for the selling in the FANG names, MAGA names, FANG Man, whatever. In order to offset the losses in those stocks, I need participation from stocks that have enough of an impact. And if I'm getting participation from stocks that don't weigh that much, I need more of those stocks that don't weigh that much to participate. So when I think of it that way, and I start to think of things pragmatically that way or objectively that way, I start to think, okay, so let me try to find some sectors or some potential names or some potential ideas for where things can go. And so when I did a little bit of digging to make this podcast, I came across a couple things. One, let me pull this up for you. Let's see if I can pull it. Nope, not there. 1 second. I'm going to pull up this. Okay. Excuse me. I just needed to pull this up so I could share it. So one, you see, and this is a visual representation for you, you see the top 5 stocks as a percentage of the total marketplace. And this is a Cornerstone Macro FactSet Bloomberg as a thank you. And you see that this is, when you see the visual, I know I said this earlier, but when you see the visual, it really puts things into context. So we're in the 1999 bubble, the top 5 names weighed approximately 40% less than where we are today, right? So this really gives you an idea of what it is that I'm saying when I say you need participation from a lot more names in order to offset some of the losses. That's number one. And when I think about like what is something or what is an index or what is a sector that could participate or could benefit if things start to go this way, one of the things that I come across is gold. So if you look on your screen, this is gold as a hedge. And if you see when this is just fundamentally the drawdown periods that we've had in the marketplace since the 60s, or since the 50s, excuse me, outside of the 1929 Great Depression. So in general, these are the sell-offs in the marketplace, and this is how gold has performed relative to the marketplace. So there's a couple of things I want to highlight here. First and foremost, the return itself doesn't always result in an exponential uptick, but the relative performance in gold relative to the S&P 500 and to the market itself is a pretty significant uptick. So going back to what I was saying just a moment ago, when I try to think about if Amazon starts to sell off, like what is a potential weight that I could start to look for in some of the things that could start to perform. And one of the first things that could start to perform is gold in and of itself. So if I just zoom out on gold, I start to see, I don't know what this is, so let me just take this off. I start to see that gold hasn't broken out of its 2011 high yet. So I'm seeing upside potential in gold. I think there might be some upside potential in gold. And if you just think of some of the things that that set us up in gold in and of itself, you've got, it doesn't matter how we as individuals quantify inflation. It only matters how the Fed quantifies inflation. And the Fed continues to pound the table and continues to say that we're in a deflationary period. That is a beneficiary of deflationary periods where the Fed starts to print more and more money is gold and precious metals in general. So that is one place that I look. I start to think, okay, gold can perform. So we know that if gold can perform, then there's a serious beta trade in gold in the miners. So mining stocks tend to outperform in these bullish gold cycles or bearish S&P downticks at almost 2 to 3-fold depending on the period. So if gold is going to start outperforming, then for me, I want to shape my list around the opinion that maybe these miners can perform and I can find some serious value and some serious beta in these miners. So if you want, you can go through the names themselves. You can go through the GDX ETF, but one that I know off the top of my head that I like is Newmont Mining. So if Newmont can get above this high water mark that it's set in late May, and it can get above that 70 level, it really starts to take off, starting to show signs and starting to look constructive across the board there in general. Another derivative of the GDX is Nugget. This one's 2 times bullish on the daily direction gold miners. So you're basically going to get 2 times the beta of GDX in and of itself. Another one is Jnug, and this one again, same thing. You're getting more torque than you would get from just trading the metal itself or from trading the GDX itself. So typically when you see a flight to one precious metal, you start to see a flight to others. Silver is another one, and silver is one that I like as well. So typically when you think about this, and when you see these things, you start to see other beneficiaries. So we're starting to see, as of this month, we're starting to see on a relative basis, we're starting to see the industrials put in a higher low relative to the last, I think, a 5-year period. So we had this this serious relative low in industrials in May, and we're now starting to see an uptick in some of the industrials on a relative basis where they're putting in a higher low and are setting themselves up for potential upside. So if I just go through, FCX is one that I want to highlight. You've got this 14 level, call it, as resistance, and then it could really start to take off. It's also got this cup and handle potentially, or whatnot. If I zoom out, this is really messy. I haven't cleaned this one up in years, but if I zoom out, you see that there's a serious downtrend in Freeport McMoRan, that if it can break out of this resistance, let me highlight this in pink for you. If it can break out of this pink line resistance, you can really start to see some momentum behind it and potentially challenge this downtrend. So outside of that, I want to go to just XLI in general. So zoom in. XLI in general, if it can get above its 200-day, it could really start to show some signs of constructive action. And then above that, you'll want to see the potentially 77 get tested. If you can get above there, we could potentially challenge the highs. Now, we did have, like I said, we had a breakdown point in late February across the board, and that level is highlighted here in pink. So if we can get above this 77, we'll potentially test this 80 level, give or take. And, if we can get above there, it can start to show some more momentum. So some of the things that could potentially get us there are an infrastructure build. If they really want to start mobilizing people and trying to offset whatever damage is done to the economy from COVID, you could really start to see the idea of let's inflate our way out of it. And that's when you can see infrastructure builds and start to see more and more ideas about like, oh, well, if we build out the roads, build out the bridges, and do all that stuff, we can really offset some of the economic destruction that took place on the back of COVID. So that's one aspect and one place that I'd look. So one in particular is Boeing. It's kind of got a mind of its own. This uptrend I'm going to highlight here in blue is an uptrend that I'd watch. If it violates, you could see further downside. For me, I like General Dynamics. General Dynamics, I prefer that one to Boeing myself. And part of the reason that I like General Dynamics is and this is not a technical perspective, this is a fundamental perspective. General Dynamics trades cheap to its peers. And if you take a look at their forward earnings, you're basically getting the Gulfstream business as a throw-in when you compare it to its peers. So I like it from that perspective, and I like it from that aspect. If I just look at Caterpillar, Caterpillar has bumped up against this 140 level, and this 140 level, if it can get above it, really sets itself up for further upside if we can get there. So 140, if we can get above there, we could potentially challenge the high water mark that is set in early January. But the important thing here that I want to know is you're starting to see some really stealth action in some of these names, and Caterpillar is a perfect example. It's almost like I just blinked and it went right back to 140. And you're starting to see moving averages here. It's highlighted by this arrow. You're starting to see some moving average confluence and support. And you can see if it starts to sell off, you'll want to see this 150-day active support there. The next one I want to highlight is GWW. I highlighted this one last week. Again, got a really wide base. You've got a really important level here on 347, 350, whatever you want to call it, give or take. And if we can take that out, it really sets itself up to potentially challenge these prior highs. Outside of that, we have Deere. When I highlighted Deere last week, Deere was in this downtrend. Well, it's broken out of that downtrend, and it's pressing up against this resistance level set at 177. Above that, you could see that high water mark that it's set back here in late February before things started to sell off. One of the things that you want to pay attention to is when things like this start to act positively, because these were some of the names that started to act poorly before we broke down. So when they're starting to act a little bit more positively, and this is something that I want to pay attention to and that you should pay attention to in that perspective, because as they start to act positively, other things will start to act positively as well. And they can, like I said, they can offset some of the damage that some of these tech names could potentially do on the downside. So another one is FedEx. FedEx started to act positively on the back of their earnings report. They had like 9 missed quarters in a row, or 6 missed quarters in a row. Excuse me. And finally, they got to a point where their bad news was just so bad that it was baked in, and now they've got a lot of upside potential before they hit this downtrend that started back in January of 2018. So FedEx can really go a long way, and I'm just going to throw an arrow here. So FedEx can go a real long way before it even tests its downtrend that has started in 2018. So this is one that I want to keep on my list as well. UPS is another one. UPS is kind of like a secondary to FedEx. It's bumping up against this 120 level, which is acting as resistance. Above that, again, we could test the high water mark that it set back in 2019 at 125. That 125 level you'll see is kind of an important one. Gets above that, and you can potentially see that that 135 level get tested. So I'm going to try to zoom in for you just to see why that 125 level, give or take, is important. So there you go. You see that is where it started to break down on a gap, and that's a gap down level. So if I could just pull this up for you, make it a little bit more clean. So there you go. This 125, 126 level coincides with where it started to really gap down. Let me pull it up even more. Okay, so there you go. So this is your gap fill level. As you can see, we get to 126, 125, 126. It runs into resistance, and then we start to sell off. But if it can get above this 120 level that it's struggling at, we can potentially see that 126 get tested. URI is another one. URI broke out of this downtrend that it's set. You can call it a cup and handle. You can call it a a little bit of a W. You can call it another cup and handle here. Bottom line is, if it can break above this recent high that it set at 166, it could potentially challenge highs from late 2019. So it's another one I want to watch. GWW. Oh yeah. So a beneficiary typically of things like this, and this is not an industrial, but it kind of benefits in a derivative sense, is Home Depot. So Home Depot is another one that's acting very constructively. It's pressing up against highs, and then its peer lows is another one that's acting very constructively, pressing up against highs. These are starting to act very favorably to the 5 and 20 day. These are names that I watch on a 5 and 20 day as well. These are some of the things that I pay attention from. So when we keep with this theme about like what are some other names that could benefit, another one that could benefit, and this one will actually help the Nasdaq on some sense, is bios. So bios have been one of my favorites. I kind of constantly go over this. It's in a 5-year consolidation, cup and handle, uptrend potential. It's broken out, whatever you want to say, however you want to say. And it's got the backdrop of COVID. It's got the backdrop of a breakout. It's got the backdrop of value. It's got the backdrop of health, whatever. So this is another instance or another place that I want to pay attention to should some of these bigger MAGA FANG man stocks start to sell off. One in particular that I like, and I mentioned this last week, I wanted to see Amgen retest its breakout level and hold that 20-day. It did just that. It gapped down below its breakout point, held this 20-day. Here I'm signifying it with an arrow, and now we're pressing up against these prior highs that it just recently made. Now, if we can get above this high that it set, let me highlight this with an arrow. If you can get above this high that it's set in early July, you could see some further action there. mRNA is one that I own Amgen. I love Amgen. That's a name that I just own personally. I own the stock. And another one that I own, and this is for a completely different reason, is Moderna. Moderna has the COVID news that it's riding, and it's been riding ever since they've gone into different phases of testing. Over the weekend, I saw something that said that they're setting up for potential acceleration of their trials, and this could create even further upside in terms of a FOMO chase. NVAX is another one that rides this COVID wave, and this one's starting to get gappy above its 5-day. So if it breaks this 5-day, I just want to look to 20. 20-day breaks, I want to look to 50. 50-day breaks, I want to look 100. And then you start to highlight. Not sure why the chart's not loading. Okay, cool. So you start to highlight different prior highs that it starts to test potentially. So it's starting to get stretched. Typically, when they start, they can go a little bit more, but it's starting to get stretched. Now, another one that I want to pay attention to is Gilead. Gilead is just now starting to wedge out of this downtrend wedge, and it's held its moving averages pretty effectively here. If it starts to get any sort of upside, it starts to get any sort of headlines, look out. It sets up for this 78 level as resistance, followed by this 80 level, give or take, and then it just sets up for 82, and then the prior high that it set here early this year. So that's kind of where my head would be at for that one. Ilmn is another one that I like. I've highlighted this one 3 times now. Really starting to act constructively on the back of a multi-year breakout potentially. And if it can get above there, get above this level that it's highlighted, which was the high water mark set in July of 2019. at 185, give or take. If we can get above there and start to show some constructive action there, it could really set itself up for further upside. Regeneron is another one that I really like. I mention this one all the time. Again, multi-year breakout, still riding an uptrend. As long as this stays constructive, you're looking for more and more highs there. And there you go, zoomed in on a daily basis. Again, high and tight, could see a resolution soon. Highlight it there. And if it can get above that, up and away. So the important thing here, though, that I want to just like stress over and over again, is I just went through two sectors. I went through industrials and I went through some bios. And this logic here is these are some of the names that could potentially offset some of the losses that we could see from some of the heavyweights in the overall market. And should that happen, you're essentially setting yourself for a positive thing, because you're starting to disperse or redistribute that money across the board rather than just having everybody play musical chairs with Facebook, Amazon, Microsoft, Netflix, and Tesla. So now that I've done that, let me just go into the ones that everybody kind of likes and loves to watch. Here's Facebook, for example. Facebook has been in this megaphone pattern that it started in on May 20th. It grinds up to this top of the pattern, and then it goes right back down to the bottom. So if Facebook can't break out of this, I'm going to look for the 200-day potentially to get tested. And if that can hold, it can provide a nice little continuation or an entry point in Facebook. Apple is on your screen here. This blue line that I've outlined. Now, this is not anything new. I constantly bring this up on Apple. Apple's been rejecting this blue line. I'm sure there's a channel there. I'm not going to try to draw it out or anything, but just understand that this is acted as resistance. If we can get above it, it could start to accelerate, but that has been a resistance point that has been respected by Apple. Microsoft, in this little downtrend, stalled right at the 5-day and right at this breakout point that it set recently. You can call that level 204. If it can't get above this level, this is a 5 and 20-day resistance. If it can't get above the 5 and 20-day, sets itself up to retest this 50-day, this prior breakout, and eventually 100 and 200 days. So that's something that I want to watch. I want to see if Microsoft can get out of this downtrend. Then we go to Google. Google is one that I own Google. I tried to make the point last week or the week before, I'm not sure, that I don't like to look at all of these FANG names as one particular group. Personally, I don't like to look at them that way because I feel like they don't all move in unison. And Google is a perfect example of this. If Facebook is at the detriment of spending because of Mark Zuckerberg's opinions and because of their inability to take action or their lack of desire to take action, that could really benefit a company like Google. Google's also cheap relative to its FANG peers, and it just recently broke out before being invalidated. So let me just highlight that there. So this arrow highlights the fake breakout in Google. So that said, Google is in this cup and handle pattern, and I kind of think that they may be the one FANG name that could surprise to the upside. I could be wrong. I own the name, so I'm biased here. I've owned the name for a while, and it's one of those core positions that I hold in my personal portfolio. So this is one that I want to watch. I want to see if the impact to Facebook advertising potentially creates a tailwind for Google in and of itself. Moving along, we have Netflix, which announced earnings last week. Netflix kind of had a blow off. Here is where I'll highlight it, where it just broke out of this channel that it resided in, and then it struggled to get back out and above that channel. And of course, they had earnings, and it just recently tested its 20-day and held. Now, in the aftermarket, Netflix did test its 50-day, and that 50-day did hold. For me, I'm looking to see a potential follow through in the next couple of days on Netflix. If it could break below this low that it's set, and for things like this, I zoom in on the hourly basis. So if it could break below this this 485, call it 480, 484 level, personally, I'll look for a potential fade in Netflix back towards that 50-day. Now, that would be a nice little reset on Netflix. It would give it an opportunity to go back to a prior high that it set, and that is something that I'd look for personally. Amazon, we've already done. I've given you an opinion there several times, so we're just going to plug along here. So Nvidia is another one that's a common household favorite. If the 20-day can continue to act as support, it's one that I'll look to see potential new highs in. If not, I'll look for the 50-day. Again, making it super basic, 50-day, then 100-day, then 200-day. That's just how I look at it. So got this little downtrend, triangle, flag, whatever you want to call it, in Nvidia. And if it could break out above, it's one that could potentially benefit. Outside of that, you want to focus on stocks. This is the semiconductor ETF for the market in general. It did break above this prior resistance level, and it's still riding the 20-day as support. If it fails there, I'll want to see this little uptrend that it's been in continue to hold. The 50-day, 100, 200-day are below. I don't believe that tech in general can continue if the semiconductors don't. That is just a fundamental opinion that I have. Now, that said, there are different names that are really looking ripe if they could break out. Avago is one of them. I've highlighted this one before. If it can get above that 332 high water mark that it set in early this year and late last year, it could really start to take off and really start to see some performance chase. Qualcomm is another one. Excellent chart here. Again, still respecting its 20-day. A failure sends it back to these moving averages. If it can break above, you're looking at potential performance chase. Intel held this moving average support, and it's now being rejected by its 50-day. If you can get above there, it's somewhere that I want to look. Micron is another one starting to come to a resolution point. As long as these moving averages and this uptrend holds, it could set itself up for further upside. Western Dig is another one. Again, same thing. Want to see, in this case, I want to see the 100-day get broken out of, and then that sets up for a 200-day test. This 85 level is acting as resistance. Above that, I want to see 87 get taken out, and then it could potentially test these prior highs. LRCX. This one has been up and away. Again, same thing. As long as the 20-day holds, it doesn't set itself up for failure. If that breaks down, I'm looking at the 50, 100-day as support. So I want to stop here for a second, and I want to emphasize that I'm not calling for upside in these names. I'm just suggesting that as long as these technical moving averages continue to hold, so I'm going to highlight this one in particular. Use this one for example. As long as the 20-day continues to hold on Lam Research, I continue to see some constructive behavior in it. If that gets taken out, the next one I want to see get held is that 50-day. So I start on the front end by explaining that your heavyweights have acted in total support of the overall market. You've had 15 names basically hold up the entire market. And so I'm just thinking, if we start to see selling in those names, what are some of the places that we can see a rotation into or continuation in to kind of hold the overall marketplace up, even though certain aspects of the Nasdaq start to sell off. So outside of that, let's just go back to Tesla. Tesla is, I've highlighted this one now a couple times. It's kind of a bubble. If it can close below this 5-day moving average that it's struggling with, or in particular if it can close below this 1470 level that it continues to hold, I think it really exposes itself for significant downside to this 100-day, or excuse me, to this 20-day, and then 50-day, 100-day, 200-day. Tesla's not one that I would chase. It's one that I would just pick levels that I want to own at. This is not a recommendation. This is just me telling you how I trade things like Tesla. I'd pick a place where I think it's going to potentially get to, or where I want to own it, and then I try to write my way into that. From this point forward in this video, I'm just going to power through some of the charts that I was asked about. So Zoom, beneficiary of the stay at home, of everybody's Zooming and everyone doing their face meetups and doing their Zoom happy hours and all that stuff. It's struggled with this 20 and 5-day. It's kind of reaching an inflection point. I really think it should test its 50-day, and I think that it will soon. That's just my opinion. So I'm looking for the 50-day, and I want to see how it behaves there. CrowdStrike is retesting a prior high. If it can hold there and get back above the 5 and 20-day, look for prior highs to be challenged. Lulu, nice little flag setting up on Lulu, or channel setting up on Lulu. If it can break above this prior 325 level, it creates about 15% upside potentially. If not, want to see that 50-day hold, and then again 50 breaks, comes right back down to the 100-day, and then right back down to the 200-day. So I'm going to highlight this with an arrow so you see this is your 50-day, breaks that, probably break the channel with it, sets up for a 100-day test, coincides with a prior high, or 200-day if it gets aggressive. Workhorse. This is one that I'm really interested in seeing because Nikola Man, Trevor himself, really fucked all of his shareholders by throwing out a bogus offering on a Friday afternoon. The offering itself is not bogus, but just the timing of it was really, really piss poor, and the stock got obliterated. So I want to see how some of these EV bubbles start to perform on the back of that. So this is one that I want to pay attention to. If the 20-day goes, got a lot of downside to get to that 50-day. Twilio is one that started to act constructively. Cloud stocks in general started to act positively relative to their peers in the tech sector. Twilio is one that I want to pay attention to. If it can take out this prior high and actually hold it, it sets itself up for further upside. This is one that's kind of gone sideways and to the right. So it's really setting itself up nicely if it doesn't get obliterated. Shopify, starting to act poorly relative to its 20 and 5 day. As long as this 920, give or take, 925, 920 level holds, it can retest the channel highs and then potentially break out. If not, look for the 50 day to get tested, which coincides with this prior high sell-off point. And then if that doesn't hold, look for this uptrend to get tested along that 100 day. Shopify is another example of a stock that trades at an exorbitant premium to its sales or any sort of metric. So this is totally trading on hype. The growth is outrageous, so I get it, and it's one that I wish I held for a lot longer. But this is, again, a particular name that trades at an extreme premium to its peers and to the market itself. Another one is FSLY, Fastly. This one's already pre-populated, so I'm looking to see this 78 level hold. If it doesn't hold, I'm looking to see the 50 day, 100 day act as support. The 100 day, by the time it got tested, would probably coincide with this uptrend. So this is one that I want to keep my name on to the short side if momentum starts to wane. Cloudflare, here's your uptrend. Again, this breaks 50 day, that breaks 100 day. By the time I got to the 100 day, could be testing a prior high, so that would be constructive. Costco on the back of positive same-store sales really broke out. It's flagging at a prior high. As long as that prior high can hold, it can potentially continue up and to the right. If not, I really would like to see Costco come back and test this breakout point in this 50 and 100 day. If that can hold, it really sets up nicely for potential buy-in. If we start to get tape bombs or if things start to get out of control, this one is potentially going to be a safe haven. It's one of those names that isn't susceptible to various headlines, because at the end of the day, people still need to shop at Costco. Walmart is one that people are optimistic on because of their recently announced Prime competition. If Walmart can get any sort of premium, it sets itself up for further upside. And this is kind of like, again, an idea of how I think of, well, if Amazon starts to sell, what are some of the names that could benefit from Amazon? And this is one that's just like directly affected based on the Amazon subscription for Prime. And it's one that could potentially directly benefit should Amazon start to sell and people need to redistribute that money. This is one that could start to get a premium moving forward. And then let's go over a couple of the other ones. Draftkings was one that I saw a lot of. This is one that people, I guess, are based on hope for sports reopening. It broke out of this little downtrend that it started and came close to testing that 100 day. It got back above its 50 day. As long as this 50, 20, and 5 day can merge here and can act as support, it can potentially set itself up to retest that 40 and then 45 levels, in that name. See if there's a couple other ones. Disney is one that's just been grinding back and forth, just chewing premium, but it is still acting as it's still showing signs of life as all these this confluence of moving averages is acting as support. If Disney can show any positive headline, it should test that 200 day and then ultimately this downtrend. Any other? I'm looking at a list here, so bear with me. Almost done here. Oh yeah, space. Space is one that I highlighted last week. I highlighted it and I said, and I'll close the video here with a little bit of a rant at the end. But space is one that I highlighted last week. I stated that if you miss the Tesla move, the logic is pretty similar here. It's a very linear idea. Either this one works or it doesn't, but there's really no other way to play that market unless you're playing that market from a Boeing, Raytheon, or similar perspective. It also has a heavy short interest, and it's also a kind of a cult following. So this is one that I highlighted last week. I said that given that it's starting to break out of a downtrend, it's got moving averages acting as support, it's got potential FOMO appeal, and it's got a heavy short interest. It really sets up for upside. We really nailed it. We're up about 33% on the name. If it can get above this 25 level, which we identified as our second target, it really sets itself up for a test of this 2750 and then 28, 75, 29 level. Above there potentially sets itself up for prior highs, but let's not get ahead of ourselves. The idea here is the same as like a beyond, which I'm going to pull up here for a second. The idea here is the same as a beyond from last year, where there was no other way to really play that market. So investors just bid the stock up. And as the stock went higher, it had heavier short interest, and it just continued to go higher. Similar concept to Tesla. Crowd favorite, no other way to play it, and could really get bid up on the back of short interest. Now that I have Beyond up here, Beyond is starting to, it's meeting this. That's really poorly done. Hold on one second. Beyond is in this downtrend channel, whatever you want to call it, or it met resistance at this downtrend. The 20-day and 50-day are starting to cross over, and it's struggling with its 5-day. These are all bearish momentum indicators. These are all bearish signs. And given the fact that it couldn't break out above its 5-day, and it's had multiple headlines recently, really sets itself up for potential downside risk. The downside risk here would be that 100-day, and then if it can break that, sets itself up for a test of this downtrend channel, which would probably by then coincide with the 200-day. So if I just go back to space real quick, for the foreseeable future, these are the kinds of names that I'm looking for outside of like gold or outside of potential names or rotation that could potentially work. I'm looking for names like space. I'm looking for asymmetric risk to the upside. I'm looking for a catalyst that could potentially push some of these smaller names up higher, because these names themselves have a smaller weight on the overall marketplace. And with that smaller weight, it really gives us an opportunity to really capitalize on a lack of weight to the overall market. So small names in general can move higher while the overall marketplace continues to sell off, because those small names don't have that big of a weight on the overall marketplace. And names like space are perfect examples of what I'm looking for in the short to medium term. With that said, I want to highlight the IWM. IWM started to act constructively recently. IWM is one that I'm looking at to offset whatever decay we might see in the Nasdaq or in the S&P. If we start to see a domestic tailoring to positions into assets, we start to see a defensive side for gold, we start to see some sort of participation in some of the regional banks. This is one that could really benefit. I've got this little blue downtrend, cup and handle, whatever you want to call it, on the IWM. If we can break out above that, we'll really start to set ourselves up for a 154 test, and then potentially a 160 test on the IWM. So I'm gonna leave it there. I know this was a very long video, so if you stuck with me, thank you. I tried to get through as many of the topics that I was asked about as possible. If I missed one, I apologize. There was a ton. I tried to do a lot of the ones that were popular. And if you have any other questions, or if you have any other concerns, you can reach out to me at EveryTimeICash, or you can reach out to me everytimeicash.com/contact. Feel free to please leave a comment below in the comments section. I see those a little bit more clearly than the ones that I see on StockTwits or Twitter. Please bear in mind that I get about 100 to 150 messages per day off my contact page, which basically I guess are emails from people that I don't know, and I get messages as well on StockTwits and on Twitter. So if I missed something, I apologize. Please leave it in the comment section below. Please like, comment, subscribe to the channel. Please share this if you found it helpful. And as always, please stay safe, stay profitable, and stay locked in.